Hi, everyone. Thank you for joining us today. We have officially hit the end of Q1 2023. So we wanted to give you an update on some of the things we saw in the first 3 months of the year, a couple of things we're keeping an eye on, and then ultimately where we go from here. If you can believe it, we had a really great start to the year, even with bank runs, inflation still elevated, couple rate hikes mixed in. The NASDAQ, which is comprised mostly of technology stocks, was up around 17% during Q1. S&P 500 up around 7%. John, we might start getting questions about Bitcoin. It was up around 72% during the quarter. Just a reminder, it is still down about 55% from those all-time highs, but we digress. We actually saw almost a complete reversal from what we saw in 2022. Last year, it was all these high technology, very expensive stocks that just got absolutely hammered as the Fed was raising rates. And now those same companies are actually the ones that perform the best. So I know, John, we echo this point all the time. It's so hard to predict and move in and out of sectors based on what you think is going to happen, and sometimes the complete opposite. I mean, just some of these numbers, Facebook, you can call it Meta if you'd like, was up 76% in the quarter. NVIDIA was up 90%, Tesla up 68%. I mean, these are just ridiculous numbers. And it just goes to show a lot of those names did carry the S&P 500 during the quarter, but we are starting to see it. A lot of these names still hold up in value. So it's interesting to see.
Yeah, I think it's interesting when things seem so obvious in investing and, higher rates and more restrictive environment means, of course, you don't want to own technology or high multiple stocks that don't have a lot of profits, things like that. And then all of a sudden you see a huge reversal. People pile back into those. They rally off the lows. It goes with our main investment philosophy of blending and not speculating in individual stocks or individual sectors, because it is so tough to do in the short run. And this is a great example of that. From where we were last year, we saw rates go from 0 to 100 as of the last Fed meeting. There's been a lot of uncertainty about what's going to happen. People thought it was going to be a half-point rate hike. Some people thought a pause. So Powell hiked by a quarter point, bringing the Fed funds rate to 4.75 to 5. Kyle and I were talking about this earlier, but I think what's important here is not so much what Powell is saying, but it's the uncertainty of where we will go from here. What I mean by that is last year we knew for sure we were going from low rates to high rates in a very short period of time. Now that inflation is starting to come down and we've seen some kind of craziness happen with SVB, First Republic, there's been a little bit of a slowdown with some layoffs and things like that. Inflation has come down from the peak. There's a lot of uncertainty of where interest rates will go from here. Powell has said that maybe we'll get to 5.1% this year. The main takeaway here is that rates are probably going to be higher for longer as they battle inflation. We don't know where rates are ultimately going to go from here and how long they're going to stay high.
They're adamant about that 2% inflation. That's their target. Powell mentioned it around 11 times in his latest press conference. We can argue why 2% and will that actually be, but they seem focused and determined to get back there. So we'll see how it all shakes out. Inflation right now is still CPI is around that 6% mark. Like John said, very unpredictable on where we'll go from here, but something we're definitely keeping an eye on. We just had 2 back-to-back quarterly gains for the S&P 500. That's a very strong sign. All 11 sectors in the S&P 500 are up off those October lows that we saw in 2022. Another positive sign. There's a chart here that Ryan Dietrich had tweeted out, basically that says if Q1 closes for the S&P 500 above what it did in December of the prior year, typically the rest of the year in the next 12 months are strong. So we hit that. Hopefully that's some good signs to come. John, I don't know if there was anything else that you're keeping an eye on here.
I think just broadly, it's quite amazing with how quickly they hiked rates last year and how far they hiked rates. It was a tough year in the stock market. It was a tough year in the bond market. But for the stocks and the bond markets to kind of hold up, obviously 20% down is tough. But you would think with historically low rates for years and years and years, with that high and fast of a rate hike, there would probably be some more blood out there than there was ending the year 20% down. In our view, stuff held up really well last year, even though it was painful. And we think this year, with the scope of rate hikes probably being a bit less, hopefully a lot less than last year, is what the outlook looks like right now. That's a positive thing in our minds. And we think that things look better from here on out. We've had a great January, which is another positive indicator when you end January up. so goes January. Typically, so goes the year, looking back historically. So just some positive signs out there. The Band-Aid has been ripped off. They've raised interest rates really, really quickly into levels we haven't seen in quite a long time. So the stock market held up pretty well. The economy held up pretty well for how aggressive that was last year, which we think is a positive sign looking out 2, 3, 4, 5 years from now.
Absolutely. That was it for our Q1 recap, everyone. Thank you for joining, and please reach out with any questions or if we can be of any assistance. Thank you.